after effects on consumption, I think it's still too early for us to kind of look at. But at the back of our minds, we are definitely kind of watching out as to how multiples will move for the sector once GLP-1 kind of takes off.
I'm going to pour you the drink and then I'm going to give you the medicine.
In the medicine, I was wondering, wow, what a connect, Harish. That's
nicely. Just joking, Harish. But that's an opportunity. Absolutely. IEX, just using that as a case study, not your view or whether, I mean, if you want to talk about the name itself, please do. But it's limit up 10%. It's a number one volume traded name on the NSE right now. What's your sense, Harish? We, by the way, had the management joining us a little later. But how are you looking at this one? And what has transpired here?
So, Prashant, unfortunately, we can't really speak on stock-specific developments. But I think platform-led businesses inherently, are loved because of their monopoly stroke duopoly kind of structure wherein winner takes all. Any kind of development which kind of impinges on this duopoly or a monopoly kind of a status, while earnings, etc., will see a lesser of an impact, the question really is what really one should give as a multiple for the future set of cash flow streams. I mean, I don't need to tell you that in any company, almost 80 or 90% of the value of the company resides in the terminal value. Terminal value is anything which is beyond the next 5 years. And therefore, when the terminal value of such an enterprise is so nebulous, wherein we don't know from the current 90% share, would it come down to 30 or 40 or 50%? It's all, balls up in the air to try and create, probability scenarios. But I would think that, there are other plays which are monopolistic, which we kind of invest in. We will kind of assess all of such opportunities as they come.
Sure. Harish, very quickly, let's talk about the good things, at least of this week. And the good thing of this week was definitely eternal, right? So I know you won't talk about the stock per se, but the big debate is whether the worst is over for quick commerce and these, food delivery platform businesses. Where do you stand on the debate?
So I think the competitive rationality is kind of starting to come through, especially as the third player also wants to get listed. I think there is going to be generally a discipline that needs to be showed for the profitability metrics to come through. The question that we kind of crystal ball gaze through is primarily about the potential TAM of this market, and that is where I guess the bigger debate for us is. Clearly, in the urban centers, the top 20 cities, quick commerce is doing exceedingly well. It's cannibalized a lot of other retail outlets. But can it thrive in tier 2, tier 3, tier 4 with lesser urban density, etc., is something I think that the jury is still out. And that will have, I think, a far greater bearing. Because again, like I said, these are all 3 lakh, 4 lakh, or 4 lakh crores in aggregate market cap entities. Almost everything is terminal value because near term is all loss making. And therefore, how this changes in 3 years will have a far greater bearing than where we are. For now, we continue to have ownership in these names.
Okay. All right. Got it, Harish. Thank you for the perspective this morning. Great conversation. Wish you a good Friday and have a good weekend as well. Let's now move on to more earnings conversations. As we do that, I'm just checking the market screen very quickly. So there's some recovery. This is what's been happening. When you hit the lower edge of the trading range, buyers emerge, and that's the good news for the Nifty. The ground is not basically caving in. So some recovery from the early opening lows, but Bajaj Finance is still down 5.5%. So just a note over here. Let's move on. More corporate conversations and more earnings. Hexaware is in focus. Now, the stock has been trading slightly lower this morning, reacting to earnings which were below expectations. Revenue growth was a little below the CNBC-TV18 poll, and margins have weakened. There are a couple of one-off expenses as well that impacted margins in the quarter gone by. So let's discuss this and more with R. Sri Krishna, Chief Executive Officer of Hexaware Technologies. Great to have you with us, Sri. So let's just start right there. The fact that there was a miss in the revenue is one thing, but also the commentary, because I think the wordings that you've used is that there is continued softness in macros. So just elaborate on this, on top line. What are you seeing around And this whole debate about whether this is just because of tariff uncertainty or whether there is a bigger disruption out there thanks to AI that's playing out.
So there are three questions there I'll address. First is the miss for the quarter itself was marginal. Okay, the softness in macros, I'm just calling what we are seeing, right? While the miss for the quarter was marginal, I think what we've also said is that because of a solid pipeline, deal wins that happened, and more importantly, solid progress in our strategic initiatives, our long-term growth outlook remains very solid. Okay. Now, your question on is it macro, is it cyclical, or is it a more structural AI issue? We think it is completely macro and cyclical. The best proof point for it is if you look at our different verticals and the growth rates of the verticals, headline is travel 23%, financial services 16% Y&Y growth. There's one sector that is materially pulling us down. That is manufacturing and consumer, negative 11.5% Y&Y growth. That's all macros. That's all the uncertainty due to tariffs.
Okay, so you're saying it's all macro, but then what does this imply? I mean, Q2, Q3, if not a guidance, but some sense on, whether this year overall you'll be better off than last year. Will it be single-digit growth? Are you looking at double digits? What's happening with client spends, deal wins? What's the pipeline looking like?
Our pipeline is very solid, okay? And not just overall pipeline, but our pipeline on strategic initiatives, which we called out specifically on legacy modernization, pipeline through a PE channel, high-tech, GCCs in India, which we did an acquisition on. All the strategic initiatives, the pipeline growth is even better than overall pipeline. What it means for a growth in the near term, we said, it's going to be our growth expectations now are a little bit lower than what it was a quarter ago. That's the reality we see, right? What it means is we will still grow nicely in Q3. It's not going to be like an outstanding quarter that it often is in Q3 for us, but we will still grow nicely.
All right. Hi, Shri. Good morning. Good to see you, Win. So quarter 3 growth will be better than quarter 2?
That's what we hope right now, yes.
As of current reckoning, it seems that, right?
Yes.
And your margins, well, it had quite a few one-offs, many actually. On a steady state, what should the margin number look like?
I mean, our reported EBITDA is 17.2% this quarter, which is a 50 bips improvement from the prior quarter. All the one-offs actually had a net negative impact of about 15 bips. So what you should expect to see going forward is that our reported EBITDA improves. As it has been for a number of quarters, it will continue to improve.
So margins will continue to improve from year on. Growth will be relatively better as well, right?
Growth will be a little bit better in Q3, definitely, than Q2. Okay. But we've said that our growth expectation for the full year is somewhat lower now than what it was a quarter ago.
Okay, all right. Just talking about the margin improvement, you have wage hikes that come into effect from July 1st. That's taken into account in this margin improvement that you're talking about.
That is correct.
Got it. All right. Now give us a few more.
What you did not ask is, will we give a wage increase? And the answer is yes. We will give a wage increase on July 1st, effective July 1st.
All right. You have given a wage increase effective July 1st, and that's already been accounted for in the margin improvement.
We haven't given it yet, but
you will be giving
it. Effective July 1st. That's what we do every single year, and we will continue that this year as well.
Got it. All right. Let's focus on the broader outlook then from year on. You had a goal of around $3 billion by 2029, I think. Does that goal hold out? And also you made a small acquisition, gone ahead and acquired SMC Squared. The revenues that it did last year was around $22 million. This year, I think in the first half itself, it's done around $16 million. How do you see this one scaling up from year on? What is the run rate you're looking at, say, in the next few years?
See, the data is this, that last year there were 1,700 GCCs in India. There's expected to be 1,000 new GCCs in the next 4 to 5 years. That's a lot of new GCCs getting set up, and that's a market that we currently do not participate in. SMC specializes in helping customers set up new GCCs. They operate it, they have different models, but the core of the model is to operate it for 3 years after they set up. So we actually expect solid demand and growth from that business.
Okay, but overall, you are a little, well, let's say, I'm not saying less optimistic, but in terms of just growth this year, you're paring down expectations now at the end of Q2 versus where you were at Q1. So let's see. We'll see how the next 2 quarters play out. Thank you very much for that. Good to have you on. And thanks for joining in. So that's a word coming in from Hexaware. Slightly cautious, but also saying that that the softness that they're seeing, it's entirely due to macros and not more structural in nature, not because of AI perhaps taking business away. So that's important. But look at that stock. Ooh, down 7%. So mid-cap IT, I mean, after many quarters of outperforming their larger cap peers so far, I mean, Persistent, Coforge, today Hexaware, not such a great run for mid-cap IT. Let's actually look at the rest of the market as well and see where we are at. Yeah, still down about 100 odd points. That's where the Nifty is. The Bank Nifty is managing a little bit of green. So for what it's worth, there is some buying on the banks. Let's see which ones. HDFC Bank is still lower. ICICI Bank has been doing better, up about 0.5%, and SBI up 0.25%. But no such luck for large NBFC players today. So Bajaj Finance 4.5% down, and Shriram is reporting numbers today. I think today itself, Shriram's down 2.5%. Shriram Finance.
Well, indeed, the stock of the morning, though, is IEX. After cracking big time yesterday, there is some buying, there is some short covering as well they are seeing, and volumes absolutely massive on that particular name. But keep in mind, it's pulling back less than a third of what it lost in yesterday's trading session. A few more names, actually, that are moving around. You have Swan Energy, that's down close on 3.5%, so big downtake out there. Ujjivan Small Finance Bank, I think that as well is reacting to its numbers. So I think we should get that one up for you on the screen. But Canara Bank, that's doing well in today's trading session. Q1 numbers were good. Profit growth was strong. Loan book as well is healthy. But margins, well, they feel some pressure. Let's discuss it in further details. We have with us Mr. Raju, the Managing Director and CEO at Canara Bank, who joins us on the show. Hi, sir. Good morning. First of all, congratulations. Last quarter was actually a good set of numbers. Give us a few details, though. I'm looking at it. Your retail book has grown very, very well. And if I remember last, the gold portfolio was around 1.5 lakh crore. You could update us. How did the gold portfolio grow in the past quarter? And more interestingly, the retail part of the gold book, that has been growing a little bit better. I think last count was around 40,000 crores. So tell us about retail book. How is it growing? The gold book, and within that, the retail portion of it. Please go ahead, sir.
Actually, first let me say that we have given guidance for this financial year during the last quarter results announcement under 13 parameters. Out of that 11 parameters, the first quarter itself we have shown very good progress beyond that what we have given the guidance. So the only thing in NIM and the CASA, these two, of course, it is a concern area for us. Except those two things, remaining all key parameters, we are excelling in the first quarter. This is because of our operational efficiency. See, we know that the NIAs will be under pressure for this whole year, but we are efficiently working for not immediately. That's the last 2 years, whatever we are working on the operational efficiency, that has started giving the results for this quarter's last quarter also, we have got the benefit out of it. Now, let me say that regarding the credit, we have given a guidance of 10 to 11%, but we are sure that we will do more than 12% growth. Even we are little cautious. Last 2 years back, we have given a guidance of that our RAM should grow better than the corporate. That's what actually earlier we were at 54% RAM. We want to move towards the 60%. And I'm happy to share with you that by June 30th, our RAM has reached to the 58% of our total loan book. Our corporate, because we know that our NIA is under stress, we are selectively going on that without compromising the pricing. That is like a corporate is growing at 10%, but the RAM is growing almost at the 15%. And there our margins are being protected. Within the RAM, housing is growing at 14% and the vehicle loan is growing at 22%. And the secured personal loan, you are talking about the gold loan. Gold loan now, as on date, we have crossed 1,91,000 crores. That is the total loan book. Out of that, almost 56,000 crores is retail personal loan book. The March we were ended at 51,000. Now we are at 56,000 in the secured retail gold loan product. Of course, the secured retail gold loan product is contributing to us majority in that, but other parameters like a housing loan and vehicle loan are also beating the market. That's why our growth in the RAM credit is almost 32%, 33% in the year-on-year basis.
Right, so I wanted to get that point out of the way because, the retail gold portion was missing. So we've got that number 1.9 lakh is the total gold portfolio and retail's around 56,000, which has been growing very well. Got that, sir. NIMs in the near term, they'll be under pressure. So for Q2, do we see it go a little bit lower, say a sub 2.5%? But what kind of a recovery are you factoring in Q3 and Q4? Can it end the year closer to around 2.7%? That's on NIMs. And on the ROA, that's done quite well, 1.1%. But a couple of brokerage notes are saying that it's run its course now. It will not expand from here. Where is it headed?
No, first let me speak on NIMs, sir. The NIMs, whatever it is, the current this 1st February there is a rate cut, April there is a rate cut, and June there is a rate cut. These three rate cuts, we have a 45% of portfolio is linked to the RLLR. Because of that, we have to pass it on to that 100 basis points. We have passed it on to the customers immediately within 1 week of announcement of the RBI. Due to that, our yield on advances has come down 36 basis points from 8.83 to 8.47. But whereas we cannot pass it on this burden on the depositors, on existing depositors, because you are supposed to pay whatever you have agreed the deposit rate till the contract is expires. Our cost of deposit is still maintaining at 5.74. We reduced our deposit rates only on the 9th of the June after latest MPC announcement, 50 to 60 basis points. That benefit we will start yielding that in this quarter onwards. Of course, with this present scenario, the stress will continue in the second quarter also, but I see that there will be a little uptake will be there in the third and fourth quarter, subject to if there are no more rate cuts are there. But if there are, again, we are hearing from various corners that again the rate cuts may be there, but every rate cut, bank has to absorb that burden at least minimum 6 months. So that will have its own impact. But if there are no further rate cuts, definitely we anticipate that it will be around 2.65 to 2.7.
And ROA, sir?
ROA, we are telling that there is no problem on the net profits. Since our net profits are comfortable, though we have given at 1.05 the guidance, we have first quarter itself 114, we have shown that. Here, let me say that everybody was worried about our PSLC income. But our PSLC income is stable and we have earned almost in the first quarter itself 1,200 crores. And even now our priority sector and agriculture and small and marginal farmers, we have enough cushion, more than 5% beyond the regulated requirements. That portfolio also we are going to encash it in the second quarter and the third quarter whenever we get a good pricing, because there is a huge demand in the market. Last year we were sold at only 1.7%, but this time we sold it almost in the first quarter 2.75 to 2.90. That's the demand is there. That is another avenue for us. And we have already approved some 1,200 crores worth of big accounts, 4-5 accounts in the OTS, which are scheduled for that time limits. We have given it for 90 days. So we are expecting that much recovery from there also. So second quarter and third quarter, we don't have any issue at this moment. But simultaneously, let me say that if you see the interest income, we could manage the absolute numbers without any fall because of our average advances have increased. So only the yield has come down, but absolute interest income we are able to maintain. Since our credit growth we are expecting beyond 12%, this interest income, absolute numbers, we will have benefit on that. So that's there won't be any effect on the net profit. So simultaneously we expect that our definitely NII, the return on average assets, ROA will be beyond our whatever the guidance we have given 105, but definitely we will be above 1.10.
Okay. All right, Mr. Raju, thanks a lot for joining in, giving us that quick outlook in terms of growth. You're quite satisfied that you have given some parameters and you have outbeaten most of them in the first quarter. We'll track you to the remaining numbers for the remainder of this year. Time to slip into a short break, but you have the management of Mphasis that's waiting to discuss their numbers. The stock, by the way, is doing quite well. Welcome back. This is Corporate Radar, and the next corporate is waiting for us. Mphasis earnings, well, they have been taking positively. The stock is up close to around 4%. We're now joined by Nitin Rakesh, the Chief Executive Officer, and Arvind Viswanathan, the Chief Financial Officer, on the show. Good morning, gentlemen, and congratulations on a good showing in the past quarter. And your commentary itself has turned quite optimistic. Now you're expecting to outbeat the industry growth by a big margin on the back of a good performance.
We'll have to flip the names a little bit. Nitin, Rakesh, and left and right. But we'll do that. Sorry, go on.
Okay, all right. We get that done. Coming across to you all, the Q1 performance itself was good. It was better than expected. You're talking about outbeating the industry growth as well, and also steady conversion of the TCV to revenue. You're saying that you'll outpace the industry growth. Do you want to put a number to it?
Again, we called out kind of like a 2x to industry growth number right now, and it's driven mostly by our own, order book as well as pipeline. I mean, we had a record order book quarter in Q1 at 760 million net new deals, which is about over 100% YOY, and we had 390 million last quarter. So I think the pipeline had been building up for the last 2 quarters, and we are glad that we were able to convert that into actual deals, and some of that translated into revenue growth within the quarter, as well as gives us a little bit more visibility over the next couple of quarters. So I think that's what's driving it. We are pegging it to 2x at this point. Last quarter, we had called for above industry. So I think the confidence really comes from the ability to look at what the order books holds and what the pipeline holds.
What about the macros? Are they improving on ground?
About a year ago, we decided that in an uncertain macro, we have to focus on the micro. What that really means is if we have the right propositions, if we have the right client needs identified, and if we take a very in-client, account-specific, deal-by-deal approach, we should be able to find a way to at least continue to grow the business despite the macro being what it is, because we can't control the macro. Coming back to your question.
Last time you had said that you're focusing on smaller deals, right? Not going after the big ones, and there is enough action happening. Maybe I'm not characterizing it correctly, but my point is you're kind of sort of looking at not the mega billion-dollar multi-year kind of things, but there's enough happening in terms of smaller size deals. And we have some numbers that in the pipeline, 68% of the deals are AI related. This is AI, applying AI, sort of implementing AI, like generative AI across clients, or something else?
I think when we said that we are focusing on large deals, for us, a large deal is 20 million or above. Even in Q1, we have 4 large deals, 3 of them over 100 million. I think that's kind of a very good sweet spot for us to operate in the 50 to 200 million range. And there is a bunch of deals in the pipeline even today that qualify for that. So just making sure that small deals don't necessarily mean $1 million, $2 million deals. On AI-led pipeline, this is a combination of a few things, right? As clients have gone through the last 2 years and looked at the ability to actually use AI to impact their tech and their operations, now there is a pretty strong appetite and a top-down push to make them more enterprise-wide, whether it is applying AI to get productivity, contact center transformation, developer productivity, applying AI to see how they run their operations, both tech and ops, claims, underwriting, support, production support, maintenance, IT help desk. So this is really, for us, it's more about applied tech. We're not going out there and building new LLMs because that's not what we need to do. There are enough and more available for us to apply. So this is really more about infusing an element of tech orchestration and bringing them together with people to deliver a solution that provides that value that the customer is looking for.
Nitin, hi, morning. So, I wanted to come to the margin picture and what this infusion of AI means for margins. And then there are other sort of factors which maybe Arvind can talk about, which are impacting margins. You've been holding, fairly comfortably around the 15% handle. But going forward, and this is not a question only for, the next quarter, but say over the course of the next year, year and a half, what will this greater AI integration mean for your margins?
Again, I think it's a little bit too early to tell. We are still in early stages of adopting a lot of these solutions, but there's definitely some play that gives us the ability to infuse a platform or codify our solution into a set of repeatable tools. That definitely gives us a little bit of an operating leverage that we can use to either pass back to the customer, get more competitive. So we don't need to really drop our margin to win a deal that is a $100 or $150 million deal. So that, I think that's established over the last 2 or 3 quarters because you just called out the fact that we've held our margins quite tightly. Whether that gives us the opportunity to expand margins over a medium to long term, I think we'll address that as we get a little bit more comfortable with scaling these deals across multiple customers.
Okay, that's an interesting point that you make over there. And we'll watch out for this. So if AI can actually be margin accretive, because there's a contrarian argument that if it just increases productivity, then shouldn't it drive costs lower? But on the other factors impacting margins, Arvind, general competitiveness in deals, wage costs, and the overall operating costs. Are you comfortable and confident of keeping margins here? Is there any scope of improvement in margins ex of AI?
We kept our margins flat, and let's say for the quarter gone by, we kept it at 15.3. largely driven on the back of significant improvement in utilization, which kind of compensated for some amount of client-specific investments and AI-specific investments that we've been doing, right? So from a range standpoint, what we've kind of said is that we would operate between the 14.75 to 15.75% range. And we are probably right bang in the middle of that. I don't see a reason for a big change. Obviously, like Nitin said, as we ramp up these deals and as we win more, it'll be important to see how we navigate. I don't think the traditional levers are going to swing it too much. But obviously, AI would be something that would be interesting to see how it plays out from a margin standpoint.
Very quickly, Nitin, you said about there are two parts: AI work, which is orchestrating AI, which is new work, and then there is using AI to do your existing work, bread and butter work. So the latter is deflationary, the former we don't know. But this agentic AI, you think it'll impact AI orchestration work itself, because you'll have these AI agents orchestrating all that? You think it'll be a big disruption very quickly?
I think to us, the value stream of AI actually cuts across. If you look at the stack that the enterprises need to build, and there's definitely an AI engineering element to that, we are actually calling it the Mphasis AI Superhighway as a solution. What that really means is you need to create an environment where you have the ability for an enterprise to be able to offer these services to the internal users, for them to be able to build AI applications on top of. So I don't think that can be disrupted by agentic AI, because that's an engineering exercise. It can be done efficiently using AI agents, but it requires an element of design, it requires an element of governance, and an element of execution that cannot be fully automated using these agents. Applying agentic AI or generative AI to existing solutions, you can call it deflationary, but I think the way we look at it is that it's unlocking deals that were probably not conducive to ROI because they were either too expensive, took too long, or had too much risk. So it's actually opening up a new addressable market, even in existing book of business.
All right, Nitin and Arvind, thank you very much, both of you, for joining us. Good speaking with you guys. Shorter conversation, but very useful as we continue to track IT numbers and IT results. Let's talk about the big story from yesterday, which is IEX, Indian Energy Exchange. The stock sold off 30% yesterday on the back of market coupling, which now is a reality. But today, it is making a comeback. It's up about 10-11% or so. We have the management joining us now. This is a CNBC-TV18 exclusive. Rohit Bajaj is Joint Managing Director at IEX. Mr. Bajaj, great to have you with us here. Thank you for doing this. Lots of questions I'm sure that you understand investors and markets overall have. And we'll talk about your operational performance and your sort of road ahead for FY26. But you'd understand I'd want to start with the market coupling story, sir. Straight up, if you can tell us, will you approach the courts to try and get a stay in terms of implementation here?
Hi, morning. So bit early days to comment on that, but let me quickly try to rephrase what is there in the order. So CRC issued order for implementing of market coupling for day-ahead market on 23rd July, day before yesterday. And it talks about initiating the process of market coupling for day-ahead market. There are a few more elements in this order where they said that due to shorter time frame available for bid submission in real-time market, and also because of other operational complexities, coupling of real-time market will be considered at a later stage. Then they also talked about doing simulation study for evaluating viability of coupling for term ahead market. And then they mentioned that we should also initiate stakeholder consultation to see whether RTM and SCED coupling is needed. Further in the order, the CRC directed its staff to initiate consultation with Grid India and all its exchanges on operational and procedural aspects of day-ahead coupling.
Yes. Mr. Bajaj, the order is well understood. Well, obviously you understand it better than most, but it's kind of understood. So my question is, what from here, sir? It obviously is a big blow to your business model. So will you try to go to the courts to get a stay?
So yes, there is going to be some impact on our business for sure. But if we see the whole thing, in the recent time, we have seen day-ahead market is not everything for us. There was a time when day-ahead market contribution in our total volume was 80-85%. But today, this number has come down to less than 35%. Other segments are also doing very well. Today, real-time market in Q1 has emerged as the biggest segment of within electricity for us. The contribution is more than 35%. So there will definitely be some blow, some impact on our volumes.
Can you quantify that, Mr. Bajaj? I think margins are about 4 paisa.
Yeah.
Which is, I mean, if you compare this to, say, international exchanges, etc., it's one of the highest. What can that number drop down to? I mean, I think in other parts of the world, that number on exchanges is the equivalent of 1 paisa. I mean, could we see that kind of an impact?
So some global exchanges, our numbers are high because their volumes are very, very high. They are trading almost 8 times or 10 times volume than what we are trading. Their margins are less. But there are some other exchanges like Australia, Singapore, and some other smaller exchanges where the margins are similar. So we are not charging margins which are very, very high. But as I mentioned, since this coupling is going for day-ahead market, which is going to be, or which is today almost 1/3 of our total volume, there would be some impact for sure. But this is not going to be huge.
Mr. Bajaj, sorry, if you could allow us to come in over here. Yeah. Let's go step by step, right? The order right now impacts the day-ahead market, which, like you explained, is now under 40% of your business. Yeah. But the order is also talking about launching experiments and eventually extending this to the real-time market and also to the term-ahead market. So that impacts all the three, different products, right? So can you tell us what the impact will be now? What is already in print, unless it's held up in courts, is the day-ahead market. So for that, I think you mentioned 30, if you could just repeat the figure. Day-ahead market is 37%. Based on that, what is the impact?
Yeah, so the order says that real-time market coupling will be considered at a later stage. So they have highlighted certain issues. So for us, there is no reason to believe that it will eventually be implemented. It will be considered. Various stakeholder consultations will be done. All the complexities will be highlighted and then it will be decided. It is not decided as on yet. So what order says is the day-ahead coupling is what they have decided today. Lot of work is required to be done. They have given the timeline, which is January 26. But we believe since the technology is not clear from where the technology will come, it has to be a common technology. Then there are other operational difficulties. How settle?
Right, Mr. Bajaj, if I can just come in. Yeah. 2 questions that I asked, if you can. One is, can you quantify the hit? You said it will be a hit, but it won't be substantial. I'm sure you looked at.
So I do not have a number to quantify that, but since, as I mentioned, since it's a 1/3 of the total segment, it is not going to be substantial. That is one.
Okay. Second is, will you go to the courts? I didn't get a clear answer.
So that's, as I said, it is little early to comment on that. We are analyzing the order, and we would be able to say anything in due course of time. Not as
we'll wait for you to form a view on whether you need to take the legal recourse or not. But for that 1/3 of your business, I'm sticking to the day-ahead segment. Yeah. What can be the loss in market share? How quickly do you think? Do you see volumes shifting immediately? As now there'll be uniform price discovery. Just help us understand. I mean, your shareholders want to know what they need to be prepared for, because that 1/3 is a reality now. So just explain how this will play out for you.
So on the 1/3, if that happens, then there is going to be a competition.
And so why
whosoever is...
That's the clear CERC order. Unless you're going to court, there's no if there, right?
So my if is pertaining to the timeline, whether it happens in January or a little more time is needed. Okay. So whenever this happens, there would definitely be going to be more competition, number one. And whosoever is able to provide better services would gain in the competition. We feel that our strength is technology. We have been in the business for 17 years and have been able to maintain very good share, as well as we have huge customer base. We have more than 5,000 customers registered with us. So that is going to be our edge. Yeah. We have people...
What is the drop in volume, sir, that you're forecasting or that you realistically think will happen in the DAM market?
Sorry, come again?
What is the drop in volumes in the day-ahead market that you see ahead from January for you?
So we would try to maintain where we are. But yes, if the competition is going to be there, definitely there could be some drop. Very difficult to put number to it. Very difficult to quantify this at this point in time.
Got it. All right, Mr. Bajaj, couple of questions now. According to you, why the CERC went ahead despite the Grid India saying that there's not much benefit? So that's point number one, because, the street was actually not expecting it. And the second part is Grid India technology ready to handle coupling?
I can answer the second part because for the first part, regulatory order is already there. Regulator has considered all the aspects and then the final order has been released.
Right, it's come as a surprise, sir, but answer the second part. Are they ready to handle it?
So, not right for me to comment on the regulatory thing, but second part, what we understand is the simulation has been done. They have some technology available there, but they have done this on post-facto basis. So it is not done on the real-time basis. It's not that when we are running the day-ahead market, similar set of front end, back end, all those things are readily available. They did it. They have taken data from all the exchanges and subsequently they did it. So technology, something is definitely there, but not up to the mark, which can be implemented immediately.
Okay, all right. So there is some technology in place. The other question I wanted to ask is on that 4 paise. Bernstein, the brokerage firm, they are saying that it could possibly come down to 3 paise. Do you think that's possible? One. And the other two exchanges, they believe now the market share is going to be divided by a third. They are eyeing 30% each. What do you have to comment on that?
So don't want to comment on what they are projecting for themselves. So
you believe you can hold on to your ground? You have the technology, some technology advantage?
We will, since as I mentioned, technology and people is what our strength is. And see, till now we were working for deepening of the market. All our efforts that were going in, we were working closely with regulator and government and ensuring that our market size should also be similar to what global markets are doing.
Right.
And we take pride in saying that by the last 5-6 years, we have almost doubled the market. In fact, we have seen 100.
Right, Mr. Bajaj, if I can come in, just a quick point, sir. And absolutely, all that is well recognized. I had a simple question. I was talking to a few investors in your company, and what they told me is that, this came as a bit of a surprise because they were being the communication from the company generally over the last few months was that this is not going to happen. That this is extremely unlikely that this will happen. So in that sense, many were taken aback when this happened, and you saw the reaction in the stock. Could you just talk to us through that? I mean, was that was that a big surprise to you as well? And was there any inkling? Because it was about communication from the company, which I heard from many investors I spoke to, a few actually. Go on.
So we were going, so the communication that we were doing was purely on the basis of results of the study, which was coming open in the market, a little bit of it. So whatever we could able to understand from the result, we were there to believe that not much saving is there. But regulator has taken overall view. They have mentioned certain things in the order. On the basis of that, they have taken view. And now the view is there. It doesn't matter what we believed earlier. Now, once the order is there, I think those things have gone past. So this is the reality. And now we are preparing to ensure that we should be able to maintain.
No, but sir, Mr. Bajaj, which brings me to the point that you made earlier. You said that you believe that this will not be extended to the real-time market. And I want to ask you where that belief comes in from. Because it's been applied. And some analysts we spoke to yesterday were saying the market actually believe that it will first come to the real-time market and maybe then gradually be implemented in the day ahead and the term ahead. If they've done it in the day ahead, what stops them from doing it in the term ahead? I mean, are you basing that view on some technological issue? Is it a tech challenge? What makes you think it won't happen to the RTM market when the regulator is saying they're going to run a pilot?
So let me explain you. Real-time market, the activities which are being done is exactly same as what we do in day-ahead market. But in day-ahead market, there is 4-hour window available to do that. In real-time market, it is 45 minutes which are available to do that. And this is very complex. You have to take bids and then carry forward things are required to be done. Bid window is only 15 minutes. Everything should get completed in next 30 minutes. So the level of complexities which are there is
more in the real-time market.
And
got that.
As you are saying that some of the people are saying that they were expecting it to come first for real-time, then they made it for DAM. So probably this is the reason they realize that we are not ready to implement this in real-time market as of now. And order also says that.
No, fair enough, sir. I got your point. Just want to understand. So you're basically, technologically, you think real time will be more complex. So it's a hope rather than maybe a belief that it won't be extended. Sir, have you had any communication with your, key shareholders yesterday, including Dalmia? They've been sort of in the market, partially offloading stake. Is there any communication with investors since yesterday in terms of any of them looking to perhaps pare down stake?
Yeah, just to add on to that, sir, is there a rule that they have to restrict their holding to 5%? Because Dalmia Bharat, they had a big 15% chunk that's come down to 10%. But is there a rule in place that they can't, no single entity can hold over 5%? That's the question. They can continue holding the 10%?
Single entity who is participant in the market, they cannot hold more than 5%.
Okay, all right.
Otherwise, the window is 25%.
So Dalmia can continue to hold on to that 10% without any tension. Got that.
Absolutely.
But have there been any conversations, whether with Dalmia or your other key, shareholders? I'm sure you must have gotten a lot of calls yesterday because this has raised fundamental issues on your business moat. So just tell us, we're just asking for the same conversation to be translated to the minority shareholders as well.
So generally, I am there for last 10, 11 years, and all these decisions are taken by the shareholders themselves. We are management. We are trying to deliver what is needed, the performance of the company, and no such discussions happens with us.
All right. They got lucky. They sold 5% at 200 rupees, so in the last quarter itself. Today, it's around 145. We'll see what they have to do. I'm reaching out to Dalmia Group and checking what they want to do. Very quickly, you're making that point on that 4 paise could possibly reduce or not. Do you think you'll hold on to this 4 paise or do you think you'll trim it down?
So I won't comment on that. Okay. If there is competition, there could be possible reduction. So I'm not saying that it cannot be reduced. It will take its own course.
But it won't go to 1 paise. You're saying it won't go to 1 paise.
At this point in time, I don't believe that it can go to that level. Globally also, the charges are reasonable and it is around that in the smaller exchange. And let us not compare ourselves with somebody like Europe where the volume are 10, 15 times.
Okay, Mr. Bajaj, we'll leave it there, sir. Thank you very much for joining us. And I really appreciate you answering all those questions and staying with us over the last 10, 15 minutes or so, taking those questions. We'll wait for whether you'll go the legal route to try go to the courts to try and get a stay. Appreciate you joining us, and we'll speak again. We'll take a quick commercial break here. Come back. It's the economy on the other side. Lata in conversation with Somikanti Ghosh of SBI, Bhavesh Jain of TransUnion Sibyl, as bank loans to MSMEs have surged in the first quarter. Stay tuned.
Welcome to It's the Economy. Today we do a deep dive into credit growth for the MSME sector. Loan growth numbers from the three top private sector banks, HDFC, Axis and ICICI, show that loans to business banking, now business banking means MSME sector, loans to that sector was more than double the overall loan growth. For instance, just look at ICICI, the MSME loan, business banking loans grew 29.7%, overall loan growth 12%. HDFC, MSME's loan 19.6%, overall loan growth 6.7%. Likewise, for Axis as well, it's double. Separately, Bajaj Finance told us yesterday they see stress in the two-wheeler and the MSME segment. Okay, their credit cost has gone up, or rather provisioning. To understand if loans to MSMEs, the surge in the loans to MSMEs is a positive sign or is it a precursor to a bad loan cycle, I have with me Soumyakanti Ghosh, Group Chief Economic Advisor of SBI and, of course, Finance Commission member. I also have with me Bhavesh Jain, Managing Director and CEO, Sibyl TransUnion. Thank you very much, gentlemen, for your time. Soumya, if I may start with you. I know you've written a lot of reports on MSME. Have you noticed the MSME sector getting healthier? How do you account for this fairly big surge in the loans to this sector?
Yeah, good morning, Lata. I think the credit to the MSME sector for the banking sector as a whole, if we take last year also, and this year, whatever results have been declared, I think credit good to the MSME sector continues to be healthy. And in fact, if you look into the overall headline credit growth and the MSME credit growth as per the disaggregated data published by RBI, the MSME credit growth is running close to around 19%, while the headline is below 10%. And this trend actually has persisted last year also, when the credit growth to the MSME sector was strong. There are, I think, three possible reasons for that, to these 3 or 4 possible reasons. First is that I think but that is basically the first could be the reason is basically a little bit technical one, is that there has been a definitional change for the MSME sector because now the turnover and the investment limit has been redefined. So a lot of non-MSME players are also migrating to the MSME sector. But that is a small technical point. The second important point is that I think the government has taken a lot of initiatives in the last 2 to 3 years, along with the banks, in terms of digitization, in terms of putting a emphasis on pushing the portfolio, the trades, receivables, and other factors are other important steps. And a third important thing is basically the guarantee cover has now been raised to 10 crores. So earlier,
you mean the CGT-MSE?
Yes, CGT-MSE. So that cover is now raised to 10 crores. And incidentally, out of the, I think on the Uttam portal, which is basically an index of the formalization of the SME sector, around 6.3 crores MSME has registered, of which 99.1% or 2% are micro borrowers. And since these micro borrowers, the outer limit is 10 crore. So therefore, the CGT SME cover being extended up to 10 crores augurs well for the sector in terms of a guarantee. So, and finally, I think the other important point is that the growth in the MSME sector seems to be real this time because there is a lot of new to credit which is happening to the sector, both across public sector banks and private sector banks.
Okay. You know, that is actually Sibyl's forte, to tell us whether there are more new to credit guys in the MSME pool. First, that question to you, Bhavesh. Before I ask you about stress, are there what you call NTC, new to credit guys, who are taking loans in that MSME segment?
Yes. Thanks and good morning for having me on the show, Lata. Yes, we do see a good, healthy number of new to credit coming through the door. It's been ranging between 47 to 51% for the last few quarters. A new to credit, which is a very healthy sign when we compare it to the other lending markets and segments. Second question around the stress. As of March 2025, we have seen the delinquencies for MSME portfolio have come down significantly as compared to the pre-pandemic times. It's almost come down to 1.8%, which is on some of the segments it's at a decade low. But when we compare it to the recent time, which is say April and May, as of May, the delinquency of 1.8 has slightly inched up to 1.9. But when we compare it on a trend-to-trend basis over the last few years, it has come down significantly.
Okay, so you're saying that, can we just go to the previous slide where you showed us the bar chart of 1.8? The total bad loans as a percentage of total loans given to MSMEs has come down significantly, as you can see, over the past 5 years. But you're saying March 2025's 1.8 is probably 1.9 for June 2025. Is that right, Mr. Jain?
Yeah, 1.9 as of May 2025.
May, okay, we don't still have June numbers.
Yes.
And you were going to give us some nuances within the numbers. You're saying that the smaller loans defaulted more under the 50 lakh category. I think that's the table that we were going with. Is that right?
Yes, so the credit exposure with below 50 lakh, the NPA levels are slightly higher. In fact, less than 10 lakh, it is significantly higher as compared to the aggregate MSME portfolio quality. And as the ticket sizes increases, we see a good trend in terms of the delinquencies coming down.
Okay, okay. Well, at the moment it is 1.9, so we will just worry a little bit. Soumya, you know, besides the 3 banks which indicated the numbers, they only said we have given more. All the 3 banks have shown very restrained NPAs. I mean, very small increase in Axis Bank's case, but that was for technical reasons, not because they said they were stressed. But Bajaj Finance numbers yesterday said that their credit cost has increased because they saw stress in the 2 and 3-wheeler segment and MSME segment. So that's why I'm asking you, do you think that there is a certain exuberance year after year, so much loan to MSME? Is there something we should worry about?
I think, Lata, at this point of time, given the initiatives, given the guarantee cover is at 10 crores, and given the fact that out of 6.3 crores, I think more than 99% are micro borrowers. So given this fact, I don't see too much amount of stress building up in the MSME portfolio in the future, because I think there has been a lot of significant steps and the walls which the RBI and the banks have built over the last 3 to 4 years to ensure that this credit grows healthy. And just to give you an example of the amount of credit which this sector actually could do, I think, and this is actually from the CIBIL data, I think out of the 6.3 crores MSME which are registered on the Uddam portal, I think 94 lakhs is the number who have got credit. And overall credit portfolio of the MSME today is around 32 trillion or so. And the per capita MSME sector in the micro loans actually is around 15 to 17 lakhs. So even if we're assuming a penetration rate of 25%, the credit potential of this overall portfolio, of which 99.23% is micro, could be in excess of around 20 trillion.
No, I take your point. Mr. Salunke, the gentleman from the SME sector, is always saying that, you know, there are 6 crore MSME companies and not even 1 crore have yet been serviced. And I agree that there is a headroom. But, you know, now we are not seeing corporate loan growth, as you can see from the 3 banks that have already reported also. Plus, Soumya, the government's capex is not going to grow. It will perhaps not fall off, but because of the fiscal deficit conditions, it's going to remain, it is going to plateau. So do you think MSMEs will have enough business to continue with this kind of loan growth? Or will banks have a problem finding good MSME borrowers?
See, as of now, the problem is of plenty. I mean, there's plenty of SME borrowers. The problem is actually of plenty as of now. Okay. And I agree with your point that corporate credit has not expanded significantly in the last 2 to 3 months. But my sense is that if the SME sector is growing, that means there is some amount of demand from the corporate sector also because of the integrated value chain. So from that perspective, I believe that as of now, we should celebrate the growth in the SME portfolio without bothering too much.
No, point taken. We should celebrate, and perhaps it will also continue because MSMEs, as I think you and Sajid pointed out, are extremely credit price sensitive. When interest rates fall, you and I may not take a home loan because we have to wait for other conditions. But the MSME jumps onto credit much faster than large corporates. Very quickly, Bhavesh Jain, do you think this growth in MSME credit at 13% CAGR is likely to continue? What was the number you got for April, May?
So it's slightly come down. It has come down to below 13%. But with the multiple initiatives by the government and the programs, it should come back. And we do see some of the large credit institutions showing the confidence in the MSME sector. And there is a huge headroom. As we had published in our CIBIL MSME Pulse report, that out of the Udyam registered MSME, the credit active population is sub 1 crore, which allows a lot of headroom for formal credit inclusion of these MSME.
Got it. Got it. Thank you very much, gentlemen. Out of time, but it was a meaningful conversation. The increase in loans to MSMEs has not exacerbated any stress. I mean, it's gone up marginally from 1.8 to 1.9 as Bhavesh Jain pointed out. But on the whole, both Soumya Gandhi Ghosh and Bhavesh Jain think that